Hey everyone, welcome back to the channel where we break down complex business concepts into simple, actionable steps. Today we're diving into something that every business owner and manager should understand: break-even analysis. It's a powerful tool that helps you know exactly when your business will start to make a profit. So if you're ready, let's begin. First off, what is break-even analysis? In simple terms, it's that point where your total revenues equal your total costs, meaning you're not making a profit, but you're not losing money either. Kind of like finally balancing your Netflix binge watching with your gym visits. You're not gaining, you're not losing, you're just staying right in the middle. Understanding this can be crucial for making decisions about pricing, launching new products, or managing costs. For instance, if you know your break-even point, you can set sales targets that ensure your business remains profitable and you don't end up selling cupcakes at a loss. Because let's face it, the only thing worse than losing money is losing money while covered in flour. Now let's break it down. How simple can break-even analysis be? Well, the formula is straightforward. Fixed cost divided by the difference between selling price per unit and the variable cost per unit. For example, if your fixed costs are $2,000, your selling price per unit is $5, your variable cost per unit is $2, your break-even point is 667 units. This means you need to sell 667 units to cover all your costs. It's like realizing you need to eat exactly 667 carrot sticks to offset that one piece of cake. It's simple math, even if it's not satisfying. But you might be wondering, should you leave this to your accountant? If your business is straightforward, you might handle this yourself. However, in more complex situations, or if you're unsure about your calculations, it might be wise to consult your accountant. After all, accountants love this stuff. It's like their version of a thriller novel, full of suspense and numbers. Is break-even analysis based on GAAP or cash-based numbers? Typically, it's based on GAAP numbers because it provides a more standardized view of your financials. However, if you operate on a cash basis, you might adjust the numbers accordingly. Either way, you're looking at the cold hard facts. No need to call Sherlock Holmes to solve this mystery. But here's another key term: contribution margin, which is the difference between your selling price and your variable cost. It's what each sale contributes towards covering your fixed costs. Keeping an eye on this helps you understand how you can quickly break even and start making a profit. Now, what should you watch out for? A common mistake is misestimating your fixed or variable costs, or not accounting for changes in sales volumes. To avoid this, make sure your data is accurate and consider different scenarios to see how they impact your break-even point. Remember, it's all fun and games until you realize you forgot to factor in the cost of your sprinkles. Imagine you run a small bakery that specializes in gourmet cupcakes. You're thinking about launching a new line of cupcakes with premium ingredients, and you want to determine how many cupcakes you need to sell in order to break even at a new price. After all, the only thing worse than eating your profits is realizing they were gluten-free. First, let's identify your costs. Let's say your monthly fixed costs, things like rent, utilities, and salaries, are $2,000. Your variable cost per cupcake, which includes ingredients and packaging, is $2. You decided to sell the new premium cupcakes for $5 each. Let's hope they're as premium as that price suggests, because no one likes a $5 disappointment. The break-even point formula is simple. Fixed cost divided by the difference between selling price per unit and variable cost per unit. In this case, 2,000 divided by 5 minus 2 is 667. So you need to sell about 667 cupcakes at $5 each to cover your $2,000 of fixed costs. That's a lot of cupcakes. Might want to start stocking up on frosting. Now let's suppose you're thinking about adding a new similar product to your lineup, and your fixed costs won't increase. Let's say the new cupcakes will be sold for $4 each, with the same $2 variable cost per unit. If you plan to sell both products in equal volumes, the average selling price and variable cost would be $4.50 per unit and $2 per unit. Using these averages, your new break-even point would be 2,000 divided by 4.5 minus 2, or 800. This means you'd need to sell a total of 800 units of the two products combined to break even. However, this doesn't mean any combination of 800 units will work. The exact mix depends on the contribution margin of each product. For example, selling more of the higher priced product means you need to sell fewer total units to cover your cost. So it's not just about hitting a number of units. It's about understanding how each product contributes to your overall profitability. Now, what if you expect different sales volumes? Let's say you plan to sell 600 of the original cupcakes and 200 of the new ones. Your total revenues and total costs would look like this. The revenue math comes to 3,800. The total variable cost comes to 1,600. Subtracting your total cost from your total revenues gives you your profit of $200. So with this sales mix, you'd make a profit of $200. And that's $200 you can invest back in your business. Or, spend it on a pizza party. This is a great example of how adding a new product, even with similar characteristics, can impact your overall break-even point and profitability. It's all about balancing your costs and understanding how each product contributes to your bottom line. And hey, if you can juggle cupcakes, you can juggle anything. Am I right or am I right? I'm right. I'm right, right? To simplify this process, you can use basic spreadsheet tools like Excel or online break-even calculators that can handle the math for you. As always, don't hesitate to consult your accountant for more complex analysis. They live for that kind of stuff. So to recap, break-even analysis is a powerful tool that helps you understand when your business will start turning a profit. It's not just about crunching numbers. It's about making smart decisions that keep your business on track. If you found this video helpful, hit that like button, subscribe to the channel, and hit the bell to be notified of future videos when they come out. And as always, if you have any questions, feel free to drop a comment down below. Thanks for watching, and I'll see you in the next video. And until then, have a great day.